really interesting, guys, because Dave, you're the CEO of a company that's taken on multiple rounds of funding. You are still private. Bill, you work for an established venture capital firm, and Chamath, you're putting a new twist on an old model, essentially. So let's start with you, Bill. How would you say the relationship between venture capitalists and CEOs have changed?
Well, one thing that's happened over the past, I'd say 15 years, is the business has just gotten way more competitive. And I think if you go way back to the early 80s, there were maybe 5 firms that mattered, and they almost worked as an oligopoly. They'd call each other and say, are we doing this deal together or not? And the power dynamic at that point was that the investors had all the power. And we moved to a world where, with so much transparency and so many dollars moving around, the entrepreneur really has the head seat at the table when those negotiations take place.
Chamath, you've got a new fund. How do you compete in a world where, as Bill said, there's a lot of capital out there, and people question, does the VC really add value?
I think part of it is just being disciplined about the stage in which you want to operate. So for someone like me, after just having spent a number of years working at some pretty iconic internet businesses and helping them, I think the most important thing that I can offer is just the actual practical advice of situations that they are probably facing every day. But in a few years, to be quite honest with you, it probably reverts back to just being another source of capital, at which point, I'm going to probably have to be on Bloomberg more often.
So you're saying you wouldn't want to be too involved in the company at all?
Well, to be very honest with you, right now, actually, I am quite involved, because I think that's where I actually can, be most helpful, because I can say, well, you know what, I tried this literally as early as, a few years ago, and in some cases with the companies that I'm helping incubate a few months ago or a few weeks ago. And so I think having your fingers in it, in my opinion, is very helpful, because it's a level of tactical advice and conversation that I think helps CEOs and help companies sort of get to that next level.
So let me kind of, the counterpoint from a lot of entrepreneurs is that VCs, all the value they create is making the decision to invest or not invest. If you happen to invest in a good company, a Twitter, a Facebook, a Google, you hit the big one, and if you didn't, you missed it. Yeah. And how much of it is that versus the work you do once you invest?
Well, I think, the real test of that is to go out and talk to entrepreneurs who have worked with different venture capitalists and get their sense of it, because they're the real judge at the end of the day. And I think there are a number of venture capitalists who may have created a bad reputation that may have led to some of those outcomes. We believe that our number one mission in life is to help young, great entrepreneurs achieve what the highest level they possibly can, and that comes through the process of strategic advice, pattern recognition from having seen what other companies have done before, a lot of senior executive recruiting. I'd say 50% of the time spent helping them recruit other senior executives and fill out their team. And so you got to earn it every day. You got to know you're in a service business, and if you're not, then it'll fall back the other way.
So, Chamath, you and I talked a couple of weeks ago about sort of this changing model and how a lot of the venture capitalists these days are getting the model wrong. What would you say that you've seen out there that you think you can do better differently,
Well, to be honest, I think what's complicated matters is, as we just talked about, there's been so much capital that's entered the sector. And by and large, this sector is actually a pretty bad sector. There are a handful of people and a handful of funds that consistently sort of can see big trends, be involved in iconic companies, help create value. But what happens is when there's just too much money, it creates all of the infrastructure that I think slows things down a lot. And so part of it is just questioning, the status quo and saying, well, why do you need sort of, to raise all this money and to generate all these fees and then to build these bloated infrastructures? Because it may actually just slow down the decision-making process and actually getting good young people to the starting line with a great idea.
Bill, how do you respond to that?
Well, actually, our firms lived through something I would say is very similar. So we, coming out of the bubble, had expanded to $1 billion fund. We were operating in multiple geographies, and we came to realize that actually distracted us from doing what we like to do best, which is spend time with the companies and help them build. So starting in about 06, 07, we went back to a $400 million fund, 6 equal partners, one of the smallest venture firms on Sand Hill Road, and allows us to practice, which we think is an artisan business, not something you can scale out to a super Walmart type infrastructure. So I kind of agree.
Oh, we agree.
So just one real quick thing. So IPOs, SurveyMonkey decided not to go public right now. Bill, you think companies should go public? Do you think that's the right outcome? Chamath, your thoughts?
I generally am somewhat skeptical of the entire IPO process. I tend to think it creates exorbitant amounts of costs. It creates a lot of distraction for management teams, and the track record, even today, if you think of some of like the most iconic, interesting companies of like the last year and a half that have gone public, by and large, it's been a very mixed track record. Whereas you see a bunch of other great companies who choose to take alternative forms of financing, and it's going really well.
Bill, quickly.
Yeah, I don't think an IPO is for everybody. You have to achieve a pretty significant level of performance, financial performance, even to be in the consideration set. But if from there you want to take your company further and farther, I think you need a public platform to make that happen. And I'd point to Bezos and Hastings and Benioff as three people that chose to do that.
I think I want to bring you into this discussion as, a guest, because you are the CEO of a company. You've taken on multiple rounds of funding, and you have decided to stay private rather than IPO right now. Why is that?
Yeah, so we're not saying we're never going public, but we felt we could continue to make long-term investments. We don't need cash. We didn't need a currency to do acquisitions. And so if we could find a way to get our investors and employees a good return on their investment while still staying private, we felt that was a better trade-off to make. And so we were able to do that. We raised $800 million in debt and equity to be able to affect that. And so that's been, I think, a good decision for us. Not every company can do that. And for some companies, I think going public is a really good thing. They need the capital, the branding event, the currency. I think LinkedIn, it's been a great thing for them. So I don't think it applies to everybody, but I think it's not always the brass ring that people have sort of put it out there to be.
Bill, you were saying earlier that if a company wants to play in the big leagues, they have to go public. Is this the right strategy?
I think there are a small number of businesses that fit the criteria that Dave's happens to fall into that allow you to stay private and to have confidence that the private market valuation for that entity is going to remain high. There's another company in Silicon Valley called Assurion that not everyone knows about that fits all those criteria and has chosen to stay private and wants to stay private for a lot of other reasons also. But yeah, I think if you want to be out there, be active in the acquisition market, in addition to the things David said, there's also this bully pulpit. If you now have a microphone and you can tell everyone how you want the industry to be perceived. I know the Blockbuster CEO felt that way when Reed Hastings was out there with Wall Street behind him and the ability to talk from a broader perspective because of that. So I think whether it's that or acquisitions or the access to capital, there's a lot of reasons you would want to be public if you're trying to expand what you're doing constantly into broader markets and have a bigger footprint.
Can companies wait to, Chamath, you're more on the don't IPO side of the coin here. What about companies that wait too long and miss their window, essentially?
Well, look, at the end of the day, I think the onus is on a company to actually build like a long-lasting, sustainable, repeatable business. And so if the comment comes up, it's because a company is really just arbitraging. And at some point, all of these things fall to earth. And so, there's a bunch of examples over like the last few months where we see businesses that may have gone out too early because they've raised so much money, they create this vector of expectations, they have all this pent-up pressure.
Is Groupon one of those?
Possibly Groupon. Zynga is probably another one.
I think Zynga went too early.
Of course. If you had stayed and figured out the real long-term business, maybe they would have made a different decision. And I think the thing is, sometimes just being private and having the ability to really reflect on a long-term business, not try to focus on arbitrage and really focus on long-term value and, making consumers or the purchasers of your product happy is actually a really good thing.
But let's go back to the public markets. What's changed in venture is a lot of companies used to go public really early. They used to go public. I took my first company public. We had, 10 million in revenue. We weren't profitable. There were lots of companies that went public really early. They used the public markets to raise capital. Now, all the bankers, they would like to take companies public, but they tell you if you don't have $1 billion valuation, don't even waste your time. Bill, you've had a little bit different attitude toward that. You've taken some companies public earlier.
Yeah, OpenTable and Zillow both went, and Jamdat both all went public on about a $10 million quarter, which is a lot less than the 100 or billion that you hear people throw out. So I think there is a lot of misinformation out there. Everything Chamath said is right. You have to have a good business. You shouldn't be going public if you don't have one. That's not a matter of going public too early. That's a matter of maybe you shouldn't have gone public at all. But then if you can, it comes down to, do you trust your ability to have a strong FP&A process where you can have predictable results so that you don't want to be creating a new pricing model your first quarter out of the gate. There's things you wouldn't want to do.
What about Twitter is one of your portfolio companies? Do you think
Correct.
Twitter is one of those companies that's waiting too long? Everybody wants to know when Twitter's going to
No, I don't think they're waiting too long. I think, look, it was just in the past 6 months that they really got their ad unit in place, which is their core pricing model. So, and I think, as everyone's talking about, I think it's performing really well. So I think they now can sit back and say, okay, when would be a good time? But trying to make that decision prior to having your pricing model figured out for your core service.
By the way, I would say Twitter is a perfect example of how a private company staying private has gotten, frankly, an extremely healthy valuation from what is otherwise a typical public investor. And that's a great thing for them.
But there are people questioning that value.
Yeah, you got to be careful. These private market valuations, where we've had this huge bubble the past few years, have created part of the problem. So Facebook probably doesn't price at 40 if it hadn't have been trading at 40 to 50 in the private market. So people are taking confidence from those illiquid markets that they really shouldn't.
Well, that brings up a good question. Chamath is an investor in Second Market, which is a private company, but is actually helping other private companies create liquidity for their stock. Tell us about that. Is this part of the staying private trend, or is there more to it than that?
No, I think that a lot of CEOs and CFOs and boards of directors are coming to the realization that, hey, look, the IPO window is difficult. It's fickle. And when I have a reasonable business and I think I can continue to build a business, and there are a lot of accredited investors, frankly, and there's trillions of dollars, sitting on the sidelines with no place to go, these things are reasonable assets. Now, I think Bill brings up a good point, which is you have to have transparency in financials. You have to make sure that these people can also fairly price things the same way a public market would. But once that's fixed, and that is fixed by things like Second Market, you would be shocked at how much money there is for private companies to stay private.
And Bill, do you like the private secondary transactions or dislike them?
I dislike them.
Why?
Because I think that one thing people lose sight of is that being public is actually an insurance mechanism for the board and for the management team. When all the processes that are in place are put there for a reason, so that investors actually don't have liability back against the company and the board. And my suspicion is that, especially had the market continued like it was, that there was going to be some significant lawsuits. There were third-tier investment banks selling Facebook shares that didn't even know the total share count, and they were on phones smiling and dialing. And that's a dangerous situation.
By the way, the one thing that's important to note here, the SEC, I think as of last week, got an actual official recommendation to create a regulated market around these private transactions.
Right.
And so once you put these things together, you'll have a private environment which, Bill and I operate in. You'll have this sort of, middle market, and then you'll have this public market. So I think once you have all tiers of capital, it's going to be really interesting.
Right. Well, we'll definitely be following the regulation side of the story, which has been slow to come until now. All right, guys.